The markets look like they're consolidating at all-time highs, and we're going to dig into the technicals, but also the reasons why the market's where it's at with Mr. Jim Welsh from Macro Tides. Jim, how are you? It's Friday. It's nice to see you.
It's great to see you, Blake. I'm glad it's also Friday because that means tomorrow is Saturday.
Tomorrow is Saturday, and I don't
Yeah.
know about you, but I'll be doing some holiday things around the house. Speaking of holiday,
Yeah.
we do have obviously. Well, it's you want to talk about a holiday? It's Friday the 13th today. I
I
guess
was
that could
hoping
be
you wouldn't bring that
could
up.
be could be a holiday. If you
Yeah.
look at intraday volatility, I think some people are being scared.
Yeah.
But no, we're coming up into the holiday season, and I want to ask you this before we get into your charts. When the holiday is approaching like this, we're starting to see liquidity really thin out. Do you have any like words of wisdom for somebody who's been in the markets for obviously a number of holidays over the years, maybe some trading tips and ideas?
Sure. Well, I think you touched on it in terms of liquidity drying up. Why? Because as you approach year end, more people say, you know what? I'm happy, especially in a year where markets on balance have done well. The tendency is to say, well, I don't need to press the game anymore. I'm going to back away. You have cross currents, not so much this year in terms of tax loss selling, because in years where the market is down, people will do tax loss selling so they can generate some tax benefits and strategies going into the next year. Um, so I
Won't you
just
do
think
some capture gains tax selling before year end?
you don't want to do that normally because the reality then is you're going to be paying taxes in April of 2025. And if you're going to sell some gains, you're going to try to then sell some losers to match up the gains and losses to minimize that. But again, what that points out is we get into next year, people can sell in January knowing they won't pay any taxes until April of 2026. And I think that is going to be one of the components why I think the market is the S&P is going to be down by 5 to 10% in the first quarter. There's other more important reasons, but if the market starts to be a little shaky, that encourages people to say, you know what? I'm going to be taking some chips off the table. So I think that aspect will be more pronounced in January than it would be this December. But I think the advice is, uh, be a little bit more selective in December. Wait for things to get oversold or overbought. And if those conditions don't develop in whatever markets you're following, just stand on the sidelines.
That makes sense. Well, Jim, we just came off of a pretty big week with inflation data. Next week is the FOMC. I'm not sure if you brought any charts for the Fed specifically. It doesn't look like you did,
No,
but
we've talked about them, and I've talked about, the CPI, what I expected. It came in almost exactly as expected. The one thing I want to note, though, is one of the things that Powell talked about during the last press conference was we're going to see a bump up in inflation, and then it's going to come down. And you and I talked about this last week in terms of the 12-month rate of change thing. The other thing that Powell talked about was that shelter inflation, as it's calculated in the CPI, is a lagging calculation. So that if you look at, and I think a couple of weeks ago I showed this chart, if you incorporated real-time data on rents and so forth, the core CPI would be closer to 2% instead of 3.3. And Powell talked about, all right, we're going to see the lag effect in terms of how shelter inflation is calculated in the CPI. It's going to start to show up as we get into next year. Well, it showed up in November. The shelter component dropped, I think, about 15 basis points. When you analyze that, that's 1.8%. So the point being is he was expecting to see this starting to happen. We've got confirmation that that in fact is happening. Again, that's why I think the Fed will cut the funds rate by 25 basis points. Not so much because per se inflation, but the majority of members on the FOMC believe the current funds rate is restrictive relative to the neutral rate. And I just think that makes sense to nudge it down one more time and then wait to see what the new administration brings in terms of its policies.
All right. Well, Jim, as far as next week goes and looking into 2025 with the Fed, are you expecting them to cut next week and then leave the door open for some cuts maybe after the first couple of meetings, or they're going to leave the door open just in general for the first meet?
Yeah.
I think they meet in January and in March. Correct me if I'm wrong.
Yeah,
Um,
the actual announcement I think is February 1st and then mid-March. It's like a January
uh,
31, February 1st meeting type
yeah,
of
yeah.
thing. No, I think the September summary of economic projections showed that the median projection was for 4 cuts next year. Well, there are 8 meetings. So right there, they're telling you, at least as of September, every other meeting. Will they reinforce that, or will the median drift down to only 3 cuts next year? That's a possibility given the uncertainty, and the data on inflation has ticked a little bit higher. They have to be respectful, not so much that they believe that inflation is a real problem, given some of the calculation methodology. But I think you just want to give that look of being tough. So this SEP is going to be important to your point in terms of markets trying to glean. Are they still at the 4 cuts next year or 3? But all these people know, Blake, is that they write these numbers down on the SCP, and it's a nice exercise. But are they going to feel like they are going to stick? Well, I wrote that down in December, and the economy is really weak as we get to March. They're going to throw that out the window,
Right, right. I
But
mean,
the
they're
markets
just
will really be
estimates.
focused on that,
Yeah, they're just estimates. All right. Well, Jim,
Yeah.
next week is going to be interesting because I think that the Fed chair has the potential to really be the Grinch that stole Christmas, or maybe Santa Claus. Who knows,
Yeah, yeah,
right?
yeah. It's certainly possible. I think again, what we've noted about Powell, he wants to keep his options open. Part of it is we're nearing an inflection point. They are truly data dependent, and therefore he's not going to commit to anything. And that's really how it's been going in recent months, recent FOMC press conferences. I don't think that's going to change. Now, how the markets respond, oh, he didn't tell us that they would be cutting, or then the markets put that spin on it. I don't think he's going to offer much in terms of real guidance. It's going to be meeting by meeting or data dependent. And again, the markets may look at it and say, well, he didn't really hold our hand, and they'll
Yeah.
react accordingly.
All
Uh,
right, Jim.
one thing before we get into the charts real quick, because there's a theme here. To me, what President Trump represents at this point in time is disruption to a lot of important things. One of the things, and so expectations are really high, as I think we all can observe, that everything's going to be really great. And, that may turn out to be the case in the short run, though, Blake. I think the policies that are going to be put forward are going to be disruptive. Think about tariffs. We're being told, hey, come on, it's a negotiating tool. Well, there's 2 sides to every negotiation. And what we saw out of the fellow from Ontario, oh, you want to negotiate? Okay, maybe we won't export all the oil to you. Or maybe, in other words, Trump is jockeying for position. Well, the other people across the table in coming months are going to be jockeying for position. And I think that's going to be somewhat disruptive as those meetings unfold. The other thing is tariffs have the potential of being inflationary. Trump has said, I want to get energy prices down. Well, the issue there is the last 4 or 5 years, oil companies, Blake, embarked on a different course. When oil prices historically were high, they increased exploration, which meant 5 years later, you got more supply. This time around, Blake, as you know, oil executives have cut back on exploration and instead used their cash flow to buy back stock and pay more dividends. And their shareholders are happy. So President Trump is going to ask these guys, hey, I want you to drill more, baby, and bring the price of oil down. Well, that's detrimental to oil companies potentially, and it's contrary to the new path that they've established in recent months. So again, my only point is expectations are really high, and I think there's going to be bumps in the road, even on the legislative front. Some of the legislation may not get through as quickly as expected and so forth. So with expectations so high, I think the market is set up, as I said earlier, for the S&P to have at least a 5 to 10% pullback as we get in the first part of next year.
All right. Well, how about can't you just guarantee us like a 5 to 45% pullback? Is that doable? I mean, would
Hey,
compliance give you a phone call? I mean, what's a just
well,
kidding.
you can say 5 to 45, and if it's minus 6%, hey, what's your problem, man? I was
Yeah,
right.
right. I was
You know,
within the window. Hey, all
well, if
right.
we're going to do that, I'm going to say a minus 1% to minus 45%.
There we go. All
Easy
right,
to
Jim,
do.
you got
Okay.
a lot of charts we need to dig through,
Yeah,
and
we'll go
all
through
the
real quick.
technicals that we want to get through.
Yep.
I do want to say this: if you guys enjoy our conversations that we have every week, Jim takes time out of his Friday to be with you guys every week. Make sure you give him a thumbs up. Comment down below if you have anything that you want to contribute to this, and make sure you subscribe to this channel. It is free to subscribe to the Trader Summit channel so you don't miss any of these very exclusive talks that Jim and I have. Jim, let's go take a look at your first chart. Your first chart is
Yeah.
household equity exposure. Now, I'm old enough to remember when I was a young buck as a stockbroker in the 90s, in the mid 90s, that when mom and pop got in, that means all the retail traders got in. It was time to sell. Is that truly the case right now?
Yeah. I mean, again, it isn't so much time to sell per se. But I think what people have to understand when you're reading all this positive news about Trump is going to be the most positive administration in terms of growth and so forth, and policies that are going to spur economic growth, great. But everybody's really, really excited. And the other thing that happens, as you well know, as the markets go down, people sell. They get afraid, they sell. Ironically, as markets go down, risk levels are actually falling. But historically, near important lows, investors are the least expensive. And then as the market goes up and up and up, and all the news is pretty good, oh yeah, that's right. Yeah, okay, I want in on that. And so what we're seeing here is the highest household equity exposure, at least going back to 1950. That's a very long time.
That is a
And
long time.
so the point is, whenever there's a widespread agreement about something, I think as investors, we have to develop the skill to try to be detached a little bit. In other words, know all the reasons why the market's doing well, but observe when you see a chart like this, like, okay, wait a second here. In the past, this has not ended well in terms of what subsequently has happened. And so it's just, to me, these are flashing yellow lights. The next chart is kind of more of the same. It's showing, this is from an outfit called Top Down Charts. He's got some great charts that he puts out. And this is, combining several different indicators that are reflective of sentiment. Well, it's the highest it's been since 1992. People are really bullish. And obviously, they've been acting on that bullishness with their money. So again, uh,
And
sentiment
it
can be,
isn't like that a direct like I mean I look at crypto and I mean crypto is like
yep,
just a direct reflection of that. I mean everybody's excited
yeah.
for the new administration. Everybody's excited to make money. Everybody's excited to make America great again. And this is that euphoria that you're talking about, right?
Right, right. So again, this is just another caution sign that when sentiment gets this one-sided, just like when we saw in 2009, 2020, 2022, especially 2003, people were really pretty negative. And it's like, okay, if people are this positive or negative, it's time to be aware that a trend change it's on the doorstep. So the next chart is showing, I believe, the Dow Jones Industrial
Oops,
Average.
sorry. Wrong one. There we go. All
What the
right.
heck is that? Okay, so this is a chart going back to, I think, 1880 on the Dow. And you look at the long-term trend and you measure the percent above that long-term trend. And it's now the highest it's been ever. Okay. Oh, no, since 1929. Pardon me. Again, this just shows you that markets have gotten very long relative to their trend. And what markets have a tendency to do is regress to the mean. So this is just another way of looking at the market from a price standpoint and realizing the other charts are kind of sentiment. This is from a price standpoint, the Dow has become very, very stretched. It doesn't mean the market's about to crash or any of that stuff. It just says that we need to be really careful and be attuned to sign from a technical standpoint of whether or not the market's trend has reversed. And the next chart, I think, goes into that. Well, no, it's one more chart about the Mag 7, I think.
Yes, this is the Mag
All
7.
right. Mag 7 has been obviously the hottest corner of the market. And what I'm trying to point out here is if you look at this chart from the low in October of 2022, you can see one up, then kind of a sideways chop into October of 23, then a huge move up into July of this summer, very hard, swift break between the peak in July and a low in early August, and then another leg up. To me, this looks like we're in the fifth wave from the low of October of 2022. It's another caution sign saying that, all right, these stocks, which have really pulled the rest of the market up with them, are approaching what could be a very significant top. The minimum expectation is it would decline back to the lows we saw in August.
But
So
but can't we just get rotation? I mean, can't people rotate out of the Mag 7 and start buying consumer staples or something else?
that's kind of what happened after the election for a little window of time, Blake, where
Yeah.
we did see rotation into the Russell cyclical stocks because Trump was going to be so good. The point I would make is here we are, day 10, the 10th trading day in December. The advanced decline line has been down 9 out of 10 days. Where has been the weakness? It's been most pronounced in cyclical stocks. So my point is that rotation, we've seen people sell cyclical so they can buy the Mag 7 again, because that's what we're seeing with this surge. I think one of the Treasury Secretary, Scott Bessent, that Trump nominated, and who, well-received nomination. They said our goal is to get the deficit down to 3%. It was 6.4% last year. So if you think about it, last year the deficit was about 2% of GDP. If you cut it in half down to 1%, or about 1 trillion, probably from 2 trillion down to 1 trillion, you're talking about $1 trillion less of government spending. You don't think that's going to have a depressant effect on the economy when you cut that stimulus away? And so my point being here is for some of Trump's policies are out there for all of us to see. You want to get the deficit from over 6% to 3. Long term, is that a good thing? Absolutely. Short run, is that going to give the economy a lift or is it going to bring it down? I think it's going to bring it down. The other aspect is tech companies have received about 50 to 80 billion dollars of money thrown at artificial intelligence. And so far, Blake, companies are not seeing a return on that investment. I think there's a risk that even long-term artificial intelligence is great and wonderful and all the things that people are promising. However, at some point in time, CEOs are going to say, hey, we just spent X amount of money the last 18 months to 2 years. Are we seeing a big increase in sales from all that? Are we seeing a reduction in costs? And so far, that hasn't been happening. At some point in time, executives will prudently say, you know what, let's dial back our spending until we see more benefits from the money we've already spent. So if NVIDIA says, yeah, our sales instead of being up 80% are only up 30, the stock's going to get hammered. If it closes, NVIDIA closes below 130, 110 to 100 becomes viable. So anyway, to me, these are all things that are on the table, and these charts are all, in my view, signaling there's too much optimism, prices are stretched, and in terms of the hottest stocks on the planet, they look to be completing 5 waves up. And once anything completes 5 waves, whether it's up or down, you're going to get a reaction move to retrace a portion of that primary move. So, these are all yellow lights flashing. And then the next chart is the S&P. And, this is all well and good. At the same time, the S&P continues to make higher highs, higher lows. Clear uptrend, no doubt about it. Short term, the 5 exponential red line is above the green 13 exponential. So to me, a top is coming, Blake. and then we're going to see a breakdown. It hasn't happened yet. That's the reality. And from a pattern standpoint, I think the S&P has the potential to have one more rally above 6,100 to complete this whole wave up from the lows at 51.19 that we saw back in a few months ago. So again, what I'm waiting for is all these yellow lights are flashing, but we need technical evidence that the upside momentum is really starting to roll over and then start to see prices breaking down. My point is, once that happens, to me, at a minimum, I would expect a 5 to 10% correction. If the disappointment about, the tariffs and, all the other things that are on the table, as I said, Trump's policies are going to be disruptive in the near term, no matter what their long-term benefit may be. That disruption, I think, has a potential of causing concern, which would lead people to say, I'm going to take some money off the table. I think that's what's coming in the first quarter.
All right. Well, I'm interested to see what it does to the dollar here, Jim. What do you have here?
Again, we've talked about this really for some time, that from the low at 99.59, which was after the dollar had peaked at 114.70 something. So it had about a 15-point decline. Then we've done an A up, A, B, C down to the low we saw in a couple months ago, and we're in wave C to complete a big corrective rebound after that 15-point decline. Wave C looks like it needs one more push above 108.07, Blake, to complete. Two legs would be equal at about 108.60 something, where A and C would be equal in length. So I think going into year end, the dollar is likely to be moving higher, maybe into early next year. I didn't have a chance to look it up, but I think the dollar peaked in the first half of January of 2017, which was the last time Trump came into office. Again, his view is a strong dollar sounds good on paper, but in the real world, not so much. I think he's going to express those views at some point in time next year. And currency traders, hey, you want your currency to go up? Great. All right, we'll jump on board. You want it to go down? We'll jump on board on that too. They're agnostic. So to me, what this suggests, Blake, is the dollar's near an important high. And then I think it's going to embark on another 15-point decline, which would take it below 95 sometime in the next 12 to 18 months.
All right, Jim. Well, the next chart is gold. So how are you feeling about gold? I thought it was having a good week, and then we did a little double top here, and
Yep.
it
Yep.
looks kind of sideways now.
Yeah. Well, when we talked last Friday, you could see you had a period of time where gold was doing almost virtually nothing. And I said, you know what? I can see it rallying above 27.19 to complete an ABC up, or it's just going to puke. Either way, the bottom line was I think it's going below 25.41. And so we completed an ABC up to 27.23. If you subtract 241 bucks from that, what do you get? 282, 2482, something like that. So I didn't update those numbers. I apologize. So that's my expectation is gold's going below 2541 and a drop below 2500 can't be ruled out. At that point in time, I think it's going to provide a short-term buying opportunity, and I would become far more positive about gold. As you remember, back in October, November, I was talking about positioning in gold. Sentiment was extremely high. It was setting up for a corrective period. We're in the middle of that. Wave two off the low back, the low, is it September 22 or something, lasted 4 months. So my assumption has been, Blake, is gold is going to be in this correction is into probably February, maybe March before it's complete. And then once this correction is complete, we're going to get, that'll be wave four. And then there'll be a wave five that takes gold above 27.89. So there's more upside coming. I just think in the near term, we're going to see more weakness.
Okay. Well, you've been really constructive on TLT, and I'm not sure if this is TLT.
It's 30-year bonds, so it's the inverse of TLT.
Inverse.
This is yield,
Yeah,
okay?
and so TLT has been going down. Yields have been rising. Are
Right.
they going to continue here?
I don't think so. Last week what I pointed out was that we had 5 waves down in the Treasury bond price, yield, pardon me, yield. What that suggested was, we were about to see a period where yields were going to tick higher, which they have, a little bit more aggressively than I would have expected, honestly. But that 5 wave decline from 467 down to 430, I think is going to be followed by first an increase in yields, and then I think we're going to see another rally in bond prices that'll bring the 30-year yield down below 430. So that's what I think is coming. And once that happens, that'll be a very, very important crossroad for the bond market. Because I can present a very bearish count, I can present a bullish count. But near term, this implies we're going to see another rally coming where treasury yields come down. But first, they have to stop. They have to stop going up.
Yeah, sure. I mean, yields have rallied quite substantially. Maybe it had a lot to do with the 10 and 30-year auctions this week. I think yesterday's 30-year auction was so.
Yeah, yeah. Well, the other thing is the producer price index came out. I mean, the CPI came out, ticked a little higher. It didn't shake anybody up. Yesterday, the PPI came in quite a bit stronger than expected. But one of the things, Blake, is 80% of the increase in the PPI month over month came from final goods. More than half of that came from egg prices.
Wow.
Okay. All right. So my point is, if something ticks up and there's a broad basket of things that are going up a fair amount, okay, that's more significant than one item goes up a whole bunch, which was the case in November. And they also revised, I think, prior months up. No surprise there that they would revise some of the inflation numbers higher after the election.
Yeah, right. Well, that is that why it looks so good during the election up
I
until
don't know, and government spending absolutely through the roof in October and November. Gee, who would have thunk it? The other thing that I read this week, and I think it's true, you never know these days, that the Biden administration is selling off whatever materials were never used to build the border wall in the South. They're selling them off for like $5. It's kind of like I'm leaving office, I'm bitter, and I'm going to give you one last little goodbye present. The agencies are spending all their money. I mean, it's sad to see people behave this way, but that's what politicians do,
yeah. Yeah, it is. It is. And I mean, there goes the same with some of the geopolitical concerns we saw over the last few months. Anyway,
Yeah.
Jim, I want to thank you for being with us as always. Your analysis is always so well received. And what's the best way for traders to follow your work?
Jim Welsh Macro at Gmail. If you want to receive a recent report, or go to macrotides.com.
Well, make sure you guys do that, and make sure you mention if you send Jim an email, mention that you saw him here on Trader Summit, and he'll give you a nice little discount.
Absolutely.
All right, Jim, I want to thank you so much for being here this week with us every week, actually, and I'll look forward to speaking with you next week before the holidays.
You got it, buddy. Thanks, Blake.
Bye-bye. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.